Welcome to the 2021 fourth quarter investment webinar with the San Diego Foundation. I'm Brian Zimbano, Vice President and Chief Development and Stewardship Officer at the San Diego Foundation. Thank you for joining us today. These quarterly investment calls are an enhanced service to our donors. These calls provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Today, we'll start with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio, sustainable portfolio, and our long-term, medium-term, intermediate-term, and short-term portfolios. We will conclude with a question and answer session. To submit questions, please use the chat function on the menu bar below at any time throughout the webinar. As any questions unanswered today will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org by tomorrow. Leading today's discussion will be Kevin Hamilton and Matt Fettig. Kevin serves as a business consultant and advisor in the investment management industry. With over 30 years of business and investment experience, spanning both the institutional and wealth management markets, Kevin has a deep understanding of the asset management business. Most recently, Kevin was managing director at Rosemont Investment Partners, where his responsibilities included portfolio construction and management, deal sourcing, and evaluating prospective investment. Since 2014, Kevin has served on our investment committee of the San Diego Foundation and is currently serving as the FY20 Vice Chair. Kevin.
Hi, everybody. Thanks for joining us. I'm going to start out my remarks with just a little bit of an overview of the year that we just experienced. And fortunately, after the year we went through, I'm glad that I still have somewhat of a full head of hair and it hasn't all gone gray, because it was one heck of a year from an investment point of view. Starting with this chart that is summarized as global equity performance by region. Usually when you look at a chart that looks like this, and I've seen a lot of them over the years, it's talking about a recovery from a bull market that might have lasted, from a bear market that might have lasted 2 or 3 years. So it's usually a chart that covers many years. And this chart does not cover many years. We actually got all of this in a 12-month period, which is pretty hard to believe. When you look at some of these individual equity markets that we've put up here, you can see that the best performing market overall was US growth stocks. And if I had asked you that question in March of last year, when growth stocks were down 24% in the first 6 weeks or so, you would have thought there was no way that they could end up the year up 38%. So if you start out down 24 and you end up 38, that means you have to have an 83% run. That's what this long period here indicates for US growth. Emerging markets, Asia also did quite well, but the reason we broke it out this way is that we wanted to show you what US value stocks or cheaper stocks did in terms of price earnings. And it's a little hard to see on my chart. Thankfully, I've got a great big screen over here that'll help me, but I hope you can see it. It's the orange line, and value stocks were down 34% during the first couple of months, and then came back 57, not 83, to finish the year at 2.8%. So you've got growth stocks up almost 40, value stocks up 2.8, which is one of the wider disparities on record. We'll get back to maybe a little bit about the why for that, but one thing that you learn in business school, finance, and throughout your investment career is that the theory is that value stocks are less expensive, so they tend to be not always the most profitable, but less risky in general, and they tend to have a lower downside in general. You wouldn't have noticed that this last year. You got down 24 for growth and down 34 for value. And then you didn't get as much of a bounce back. So you just can't ever tell in the short run what you're going to get. But if we go on to the next slide, which describes this a little further, this is a chart of value versus growth PE ratios, or how expensive these different areas of the market are. So I'm just going to take you through it quickly. It goes all the way back to before the dot-com bubble in 97. So you can see going to 99 from 97 when growth stocks got very expensive, especially if you had anything to do with the internet. That's shown here, way down here at the bottom, where growth is the most expensive. It's a little reverse, but even though you're down at the bottom, growth is expensive. Then you go through a run all the way to the great financial crisis, where by and large, value stocks were coming back. And part of the reason for that was the great financial crisis featured an awful lot of financial stocks. Financial stocks became the biggest part of the index at that time. They tend to be value oriented in pricing. And after that, you get this trend downwards pretty much for the last 10 years, more or less, where growth has either been even with or slowly getting more expensive relative to value and its history. And so that's where we are today. You get all kinds of questions all the time about, are we in another growth bubble? How expensive are these stocks? So on and so forth. So if you look at this, you do get a feel for the fact that while growth stocks are expensive, where they ended the year, not nearly to the degree compared to value stocks that we saw 20 years ago in the dot-com bubble. There's still room, but there are other similarities with that period in time. For those of you who were active investors back then, like I was, you couldn't get into a taxi cab in New York without finding somebody who knew something pretty good about a wide variety of the hottest growth stocks in the market. And these days, you find the same thing, but they come by a different name. If you've been reading anything about it, they're called the Robin Hoodies, and they are busy staying at home, learning about investing, trading for free, because we have got a lot of time on our hands at home. So that's where value versus growth has gone. Our portfolio is diversified across both of those factors. We don't have a crystal ball that tells us in the short run where these markets are going to go, and we want to have some degree of exposure to both of these categories of stocks over time. If you move on to the next slide, part of the reason that 2020 was so tumultuous, and part of the reason that the market came roaring back, is because we got some good government help from the Fed in the way of rapidly cutting interest rates to zero, where they are now, basically, and basically a promise from the Fed that they're going to keep rates there for some period of time, or as long as is necessary to mount a reasonable comeback. So that helps inject the market with liquidity, which is great. It also does some other unintended things. One thing is it gives investors the feeling that they can maybe take more risk than they otherwise would have, because the Fed stands ready to help bail us all out. It's called the Fed put. If you go back to the mid-90s when that term was first used. But that's where we are now. You can see at the dot-com bubble, Fed aggressively dropped rates to help get us out of that. They took rates to zero right after the great financial crisis in '07 and held it there for a decent period of time, about 6 years. And over the last few years had been slowly ratcheting back up to a more normalized interest rate structure until we got the COVID surprise. So with that said, let's take a look at the next slide. Over the course of the 20 or so years since 2000, since the dot-com bubble, rates have largely been trending down throughout this entire period. And they've been trending down for long-term structural macro reasons. But that's not what this chart says. When I first looked at it, I thought, okay, this looks like trending down interest rates. But what this chart tells us is theoretically, what would have happened over these various calendar years if the Barclays aggregate or longer term interest rates had been taken to zero. Remember, when yields fall, you get capital gains from bonds, from fixed income instruments. So when yields are falling, you get better returns out of bonds than the coupon that you would earn. The coupon being the kind of the interest payment on the loan that a bond investor provides. So, you go back to 2000, theoretically, if interest rates had fallen all the way to zero during that time, you would have gotten a 40% return from your bond portfolio. Not very realistic, but just for illustrative purposes. If you flash forward to where we are now, because we are so close to zero in terms of interest rates, the 10-year right now is at about 1.4 or so in terms of yield, but it finished the year at about 0.9, and it got as low during 2020 as 0.5. Because we're getting closer and closer to that zero line of zero interest rates, it means there's not as much opportunity for bonds to appreciate in that environment. So what that tells you is that bonds have been the great diversifier relative to equity risk over generations. Well, how good a diversifier are they going to be going forward? If rates went to zero, for example, and equities didn't perform very well, that's usually suggestive of an environment like that. How much are you going to get out of your bond portfolio today? Well, the truth is you're going to get a lot less because we're so close to zero. So that is a topic that we are spending a lot of time talking about in our investment committee. And that same discussion, I think, is being had in a lot of boardrooms and a lot of investment committees for large scale money these days. Because if you're not going to get as much protection out of the bonds as you might like when you need it, how much do you want to keep there? And what are the alternatives for how to try to provide that protection in a better way? So those are all ongoing discussions that we're having and that Matt is working on during his time as well. I think at this point, I'm going to turn it over to Matt. You can come back and ask questions of any of this later. But Matt, do you want to touch on endowment performance?
Thank you, Kevin, and good afternoon, everybody. Thanks for joining us. Typically, February or March every year, we tend to have an in-person investment summit where we invite you to join us for lunch and hear from some guest speakers. And here we are a year later sitting at home, and it is quite disappointing that we're not able to get together with all of you today. But as soon as things open back up, we will host an in-person event, and I look forward to seeing everyone at that time. So let's talk about performance. And, I'm going to just talk a little bit first about Kevin's last slide and fixed income. I think it's important The Fed is, with zero interest rates, encouraging asset price inflation. And we have seen that for 10 to 12 years since the great financial crisis. With very low interest rates here and across the globe. If anyone's heard the acronym TINA, TINA, there is no alternative to equities. And as a result, people have taken a lot of risk in their portfolios, maybe more risk than they intended to, because there really is no yield out there from instruments like fixed income. I say that because in the endowment, we have a required rate of return. We need to keep up with inflation because this is perpetual long-term money. And inflation typically averages about 2.5% a year. And we also need to keep up with the rate of spending from these endowment portfolios. And that rate is currently 5%. So we need a 7.5% rate of return about over time to really just break even. And when you have an instrument like fixed income with rates as low as they are, and you're not expecting, number one, much in the way of yield or interest payment, and number two, they're priced to perfection, and number three, they offer less what I'll call protection in the event of an exogenous shock to the equity markets. You see, we have about 12.6% of the portfolio in US fixed income and 1.4% in non-US fixed income. And that is a very important conversation to have when that could be a drag to you meeting your required rate of return over time. So that is really hot, really kind of hot topic that is in our minds. And when I get to some of the other portfolios that don't necessarily have a required rate of return, I'll tell you why it's perhaps a little bit less important. But let's start with looking at these numbers. Really remarkable that over the 1 year period, 13.5% return for the endowment, despite how bad it was in February and March. We're quite proud of these numbers. It is human nature to panic when you see the market plummeting every day, day after day, as sharp as it did, to just get out of the way. And the discipline that we maintain as institutional investors is not to get out of the way, but to actually rebalance into things that have gotten cheaper, like stocks. And we were able to take advantage of that and post a very strong year. I will just mention the year-to-date column listed here is actually the San Diego Foundation's fiscal year-to-date. So it's just July 1st through December 31st. And you can see the second half of 2020 was just very, very strong. And look at that 10-year number, 7.4% over the last 10 years. I said we need 7.5 on average. We're right there. And I'd argue that inflation was lower than over the last 10 years than that 2.5% average. So we're demonstrating some real growth, but very proud to have all of these numbers above the policy index. That's how we measure ourselves. One point I'd really like to make, and we've talked about over time, is with only 12, we call it 14% total fixed income, we've had to look for other opportunities to deploy capital. We can't just put it all in stocks. We want to be diversified. And so we've added exposure like hedge funds, real assets, real estate, private equity, private credit. You see all those smaller slices of the pie. And we've talked a lot about how one of our focuses was to increase the exposure in this endowment portfolio to private market assets. So private equity, private credit These are essentially stocks and bonds that are not publicly listed, but it's the stocks and bonds of private companies. They tend to be illiquid, which is okay. They're a small part of the portfolio. And we believe, and it's been proven over time, that you actually get paid a premium over public markets to hold illiquid positions. It's called the liquidity premium. And the problem we've had the last several years is that when you start to build a private portfolio, you're typically paying fees in the early years. The managers are acquiring private companies. And oftentimes, they're trying to improve the operations of those companies. Well, that doesn't happen overnight. That takes time. And so as you're paying fees, and these companies are really held at the purchase price, you tend to go through what's called the J curve. It's a structural period of underperformance as you're building out a private portfolio. And we went through the J curve where our private markets exposure was hurting us for a few years. I'm proud to say in 2020 that reversed in a major way. It happened for a couple reasons. Number one, growth stocks in the private market have been hot. Areas like software. And you have to pay some pretty crazy valuations to acquire companies like that. We've participated in some of that, but we've also taken a little bit more of a conservative approach, really having more of a value orientation in our private equity bucket. And when COVID hit, what we found is that almost all of the companies we owned, the underlying companies, were essential companies that were allowed to stay open through the pandemic and were able to really deliver strong results relative to their peers. And as a result, we saw very, very strong performance out of our private bucket for the calendar year 2020. And if I look away from the camera, apologies, as I'm looking at my other screen, just over the last year, our private equity portfolio was up 26.1%. That's 26%. And to give you a sense of how we measure ourselves against a universe of other private equity managers, that index was up 14.7%. So we had over 11% outperformance just from our private companies. Over the last 6 months, the portfolio was up over 30%, and well ahead of the benchmark, up 20%. So that is really starting to work, and it's an advantage of having long-term perpetual capital. You can lock up a portion of your assets and have less liquidity as long as you can continue to meet your spending needs and really benefit from that illiquidity premium. And quite frankly, if you look at the number of publicly listed companies across the globe today, it has shrunk dramatically over the last 10 years. Private companies are staying private for longer, and that, while there is a lot of money flowing into the private space, creates great opportunity. So let's move on to the next page, and this is our long-term portfolio. You can see over the 1 year period, the long-term portfolio up 11.7% in line with the policy index. It had a very strong fourth quarter. This is our longest duration portfolio for non-endowment funds. That means any fund holder has the right to grant out all of their money at any time from this portfolio. So we don't have things like illiquid assets in this portfolio, as we need to have liquidity in the event our donors require it. You can see longer term 7-10 years, slightly trailing the policy index, but still up a healthy over 6%. And there's a couple stories to point out here. Number one, we've been slightly overweight the US market, which was a good thing last year. We were also slightly overweight the emerging markets like China, Russia, India, Brazil. Emerging markets were one of the best performing areas last year. And even in the fixed income bucket with 19%, it's almost shocking the amount of outperformance we had in the fixed income bucket. As I'm pulling it up, the bond portfolio was up 10.5% for the calendar year 2020. Our fixed income benchmark was up 7.6, so almost 3% of outperformance in bonds. Bonds is typically what you call a basis point game. If you can outperform by 0.1%, 0.2%, you're doing pretty good. To have 3% nearly outperformance for a 1-year period is really something, and a good a reason for some of the stronger performance that we've seen over the last year. I will say with rates at zero that, you know, we can't expect 10% rate of a 10% rate of return from fixed income in the future. There's a thing called bond math where you can pretty easily calculate an expected rate of return depending on what interest rates do. And the bond math with rates near zero just doesn't allow for much of a robust expectation from that area. Let's go to the next slide, and we'll talk a little bit more about it. So this is our medium-term portfolio, and remember, this is for money that is expected to be invested with us for, call it 3 to 5 year period. Therefore, we don't want as much volatility in this portfolio. So we have far less in areas like stocks and much more in areas like bonds. And in this particular situation, you can see 1 year number up 11.2%. It was really 2020 was the perfect storm for this portfolio to the upside, where bonds were up very, very significantly, stocks were up very, very significantly, and therefore it's really allowed this portfolio to excel. On a go-forward basis with 60% in fixed income, again, we have to really temper our expectations as to what this portfolio may be able to deliver in the future. But certainly, if you were an investor in this portfolio for 2020, and even for the last 3 or 5 years, you've done much better than any of us probably would have expected this portfolio to do. Next slide. So let's talk a little bit about our new portfolio. We talked about this on our last call. On January 1st, we launched what we're calling the intermediate term non-endowment portfolio. With rates at zero, if you hold cash, you are getting paid zero. Short-term interest rates and money market fund rates are correlated, highly correlated. And in some cases, for the last many years, donors that were in our short-term portfolio were getting paid zero. After the San Diego Foundation takes its fee, you're seeing a slight loss every month. So we created this new intermediate term portfolio for funds that might be with us for a 2 to 3 year period. This portfolio consists 100% bonds. It's 60% intermediate term bonds and 40% short-term bonds. So launched on January 1st, 2021, we do not have any performance to share with you yet, as this performance report we're sharing with you is through the fourth quarter. But more to come on this. and an option to hopefully get some yield on top of what cash is offering. And again, cash is offering 0 right now. Should you have any interest in this type of portfolio, if you perhaps are in short term and are looking to change, I'd encourage you to reach out to your donor manager at the San Diego Foundation, and we can talk more about it. But I do want to make one final point, and I think Kevin has a question too, and that is this whole idea that the Fed is forcing us to take additional risk. We don't have a required rate of return in these non-endowment portfolios. So we could take more risk by ramping up our exposure to stocks. But with the stock market trading at a fair to rich valuation, it's a difficult thing to do. So without a required rate of return, we're not chasing the market and trying to take on additional risk, chasing potentially more return. And Kevin, did you have a comment?
I just wanted to ask you, Matt, do you remember what the yield is on this portfolio?
The yield is probably changed a little bit because interest rates have gone up on the longer end of the curve. But we were looking at about a 2% yield for this portfolio.
There you go.
Now, if we kind of guesstimate how well this portfolio has fared so well or so far, it's probably producing a negative rate of return from January 31st to today. And the reason I say that is because this portfolio will take on interest rate risk. And to Kevin's point earlier, as longer term interest rates rise, bond prices tend to fall and you have capital depreciation. My guess would be that we've had some of that, as you have seen the 10-year Treasury increase from 90 basis points at the end of the year to 1.4% today. And next slide, please. Finally, the short-term portfolio. So note that the numbers we're showing you here, each column or each bar is the return for the quarter. And you can see for the fourth quarter of 2019, a 0.4% rate of return. For the first quarter of 2020, a 0.3% rate of return. And as short-term interest rates were cut to 0 by the Fed, some zeros. We do not expect this portfolio to generate any yield until there is some kind of change in short-term interest rate policy by the Federal Reserve. And all indications so far are that the Fed plans to keep rates low for a longer period of time. That is why the intermediate term portfolio has been created and why we'd be happy to talk with you about other potential options should sitting in cash and earning 0 not be something you are looking to do with your charitable dollars. So, a couple other things I wanted to note. We have on January 1st of 2020, so a year ago, we created 2 new investment options for donors. The first is what we call our Sustainable Endowment Portfolio. The second, which we'll get to in a minute, is our Sustainable Non-Endowment Portfolio. And effectively what these portfolios do is they invest about 70% of their capital in global stocks. And I apologize, this domestic equity tag is wrong. That should actually say global equity. And 30% or so in domestic bonds. And they follow what we call ESG criteria. ESG stands for environmental, social, and governance criteria. Furthermore, we take things a step farther on the environmental side and ask our investment managers to divest from fossil fuel producing companies. And so we have a year of history now for this portfolio. You can see the endowment is about $6 million. A little overweight stocks, given the run that we had in November and December, but that has been rebalanced back to 70-30. But look at the returns. The 1-year number up 24.9% versus the policy index at 14.8%. I don't want to lead everyone the wrong way. Divesting from fossil fuels played a major role in our ability to generate this outperformance. It just so happened that if you look at 2020, energy was the worst performing sector of the market. And as such, just by cutting out exposure to energy companies, we outperform the rest of the market. So there is some argument in the community, debate, I should really say, as to whether perhaps following ESG criteria can lead to better long-term rates of return. I wouldn't call this 1-year number a long-term rate of return. It's much shorter. We would expect there to be more volatility, especially if a sector like energy really did well in 2021, but off to a very, very good start. And if you flip the page to the sustainable non-endowment portfolio, it's really invested the same way with the same managers and produced another kind of amazing absolute and relative return for 2020.
Smart.
Kevin, you have a question?
Well, I was just going to add that these numbers fall in a little bit into the better to be lucky than smart category. Whereas the first portfolio, the endowment portfolio, those returns have been generated from a lot of thoughtful investment work on the foundation's part and on Matt's part in particular. Sometimes it's just fortunate to get started in something new and have the wind at your back right from the gate.
Well, we will take that. A little bit of luck never hurts. So with that, that concludes my comments. I'm going to turn it back over to Brian Zambano.
Thanks, Matt. Thanks, Kevin. And again, this is a good time for everyone to ask any questions you may have by entering into the chat section below. And I know we had a few questions come in prior to some folks who had a few specific inquiries. Matt, I believe you and Kevin are prepared to answer a few of the questions we already have.
Sure. So I will pose this first question to Kevin. How do you protect the portfolio against the possibility of unexpected inflation?
Okay, well, first it depends on which portfolio. In a long-term portfolio like the endowment portfolio, we've got a relatively small allocation to fixed income, and fixed income as a general rule will tend not to do very well in an inflationary environment, but equities, real assets and real estate, things like that can keep up because they have pricing ability, they do tend to do better. So that's one part of the equation, but also another factor that relates both to the endowment portfolio and the shorter term portfolios that have more fixed income exposure because of the time horizon. What you do is you craft a fixed income portfolio specifically that is designed to be a little less sensitive to interest rates. Inflation starts to accelerate. That's reflected usually in interest rates, nominal interest rates in particular. So you create a portfolio that has less sensitivity to interest rates. And it's not a free lunch out there, so you have to have sensitivity to something. And those fixed income portfolios will tend to be a little bit more sensitive to the credit environment, but not to the inflation environment. And that's the way we basically have built the fixed income exposure throughout all of our portfolios. Matt, anything to add to that?
Yeah, I would just say if you are a fixed income investor sitting in a 10-year treasury, or let's say you're purchasing a 10-year treasury bill today or bond, you're going to receive 1.5% a year for 10 years and then get your money back, 1.4% that is. If inflation is anywhere close to its long-term average of 2.5%, 10 years from now, you are going to be losing money on an inflation-adjusted basis. And as such, it's very, very difficult to see value in things like treasuries. And so, as Kevin mentioned, that tends to be far less of a focus, where our managers in the fixed income area are tending to look at other instruments like mortgages, corporate credit, etc.
Exactly.
Second question, which I will take this one. What is included in your real estate portfolio, and how susceptible is it to concerns around COVID-19 and the future of remote working? There's quite a bit to unwrap with this question, and I'm gonna talk about the endowment, because that is where we have the bulk of our real estate exposure. The first thing I would say is that almost all of our real estate exposure in the endowment comes in the private market. So we are investing in funds that are professionally managed, where our managers are going out and buying a diversified portfolio of real estate properties. And there tends to be 4 key sectors in which they're participating. The first is an industrial space. Think about industrial as anything from your 1,000,000 square foot Amazon location in the Inland Empire, to some smaller 50 to 100,000 square foot industrial centers that are benefiting from the trends in online retail. Second is office. We all know what office space is and what office buildings are. Third, multifamily, which are essentially apartments and apartment complexes. And finally, retail. And retail could be anything from a shopping mall to a grocery anchored corner lot that has a grocery store and smaller other retail spaces. So we have exposure to all of those areas. Our managers are making sure that they minimize their exposure to things like malls, and they minimize their exposure to overdeveloped geographic areas of office, like New York. If anyone has seen the whole Hudson Yard project that has gone in, and there is a lot of empty office space. And focusing much more on the industrial space and the multifamily space. Number 2, we're investing with managers that are going to take advantage of perhaps some of the carnage that might develop in the real estate space and be able to buy assets for cheap. Now, when you look at our exposure to real estate, probably the biggest unknown is office. And that feeds into the question, which was the future of remote working. We just don't know yet what office will look like in high metropolitan areas. Will people go back to work full time in the office? Probably not. Will they want to keep a space in the office and go back part-time? More than likely. Will this trend of moving out of urban areas into suburban areas end when COVID-19 concerns are under wraps? It's hard to say. So the one thing I will say is we are very underweight real estate today. We like our position being underweight real estate. We're more focused on multifamily and industrials, where we think there is less susceptibility to some of the risks associated with COVID. And we're looking at opportunistic plays where we can come in and be a lender of last resort, or buy assets that are very cheap, turn those assets around and reposition them into the market. Kevin, anything I missed there?
No, I think you got that covered well.
Great. Brian, have we had any other questions come in?
No, I believe that's it. But to reiterate Matt's invitation earlier today, any questions or anything from here that you have may impact your decision about your fund, or you want to talk through it more, please don't hesitate to contact us on the development team. Look forward to chatting with you more. And thanks so much for joining us today and for partnering with the San Diego Foundation, where we're leading change today for a better tomorrow. Today's presentation
Thank you.
on our website at sdfoundation.org/investments. Thanks again and have a wonderful day.